Once you have your entities and goals set up within Portfolio Tracker, part of Real Estate Investor membership, you're able to go in and create the properties that sit within those ownership structures. For the example today, we're using the personal ownership structure, and we'll be adding a couple of properties to that ownership structure. Click on My Properties. As you can see, if you have multiple structures you set up, you're able to look at all entities or individual structures that you set up. We're going to choose Add a New Property. As you type a property, you're then able to leverage Google's search capabilities to be able to find the address of your property. Enter in the land size, the type of property, bedrooms, bathrooms, and car parks. If it's a new purchase, you can enter the new purchase details. If you already own it, which will be most likely for our members, click on I already own it, and you'll be asked to put in place how much you owe on the property, the market value of the property, the initial purchase price of the property, and when you purchase the property. Click back in time by clicking at the top of the calendar and choose the year that you actually purchased the investment property. If you've completed capital improvements at the time of purchase, you can factor those in. You can also adjust the solicitors or conveyancing costs, and you can calculate stamp duty. Choose the state location, the purchase price, whether it was to live in or as an investment, whether it's an established home, newly constructed or vacant land, and whether or not you're a first home buyer. This will calculate the amount of stamp duty that was applicable. Any other costs in relation to purchase, just enter those here. Scrolling down, we now have the loan details. You can put a new loan or an existing loan. By default, it asks for one loan. You can put additional loans by clicking on the plus symbol. Put in place the lender, the loan reference, whether it's interest only or principal and interest, choose the amount of time remaining on the loan, and any interest-free periods. Confirm the loan balance and the date that you confirm that loan balance. Adjust the interest rate as applicable, and you can choose a particular date that you'd like to be reminded to check the interest rate. For example, if it's coming up in 5 years' time, we will automatically jump ahead 5 years' time from now as to when the fixed interest period will end, and we'll send you an email. Click Rent and Expenses. On the next screen, you'll be asked to confirm your expenses and rental income for the property. Put in place how much you're getting per week, how many weeks of the year you want it available for rent or are you expecting in terms of occupancy. If you have a holiday rental, you have the ability to click on holiday rental and put in place a number of weeks, occupancy rate and rent based on the peak, shoulder and off-peak periods. Look over your annual property expenses, adjust them accordingly. If you have tenants already in place, you can enter them here, put in place their lease start, their lease end, and when the next rent review might be. The Prorata first year income and expenses looks at when you purchase the property and when the next end of financial year is coming. By default, the software will calculate 1 year's worth of expenses for year one of you owning the property. However, if you've bought halfway through the year, you don't want to see a full year's worth of expenses calculated for year one. You only want to see half the year's expenses calculated. So if you decide to prorata your expenses, you can choose the date from until, most likely being the end of the financial year. Or alternatively, if you sold it before the end of the financial year, you can choose that as your end date as well. Most of us will go with the don't prorata the expenses. On the tax and market screen, we have the ability to confirm the ownership structure. If you've created additional entities, you can choose the entity that you'd like to hold the property within from this drop down, or if you forgot to create it, you can create a new entity directly from this screen. Today's property will be a personally owned property, and we're saying that the personal ownership structure has 100% ownership of this property. This means that if you're a 50-50 joint venture with someone else, you can choose 50% as the ownership for this property, and any income and expenses, etc., will be broken down to a 50% basis. You can look at the inflation and the capital growth. The Consumer Price Index factors in growth for rent and other expenses relating to the property, so they'll grow at 3% over time. Capital growth will take this as your default growth for your property if and when we're not able to calculate a long-term growth average for that type of property in that suburb. In most cases, we'll be able to calculate the capital growth based on historics, but when we're not able to, we'll take the number that you've indicated within the capital growth field. Put in place any land tax, and scroll down to our depreciation estimation calculator. This is powered by Washington Brown. If you click on the Washington Brown logo, you're able to go to their website and order a depreciation report if you don't have one already. The thing to remember here is always choose when the year was complete in terms of when the property was built. So this property today we're going to say was built in 1970. It's a house and the nearest capital city is Melbourne. You want to look at the quality based on any recent renovations. So if it was renovated in the 90s and perhaps it was built in the 70s, it's going to be a little bit better than a low property in terms of depreciation. So I go with medium. If it's been renovated really recently to a high level, choose high as your depreciation level. We're going to choose medium, and then choose when you want the schedule to be applied from. So if you purchased the property a long time ago, but you only recently had the depreciation report completed, start the estimation from when you plan to have your depreciation report being used from a tax perspective. If it's been in place for some time, just go back to when you purchased the property. We'll say that we've got our depreciation schedule today. Click Save and Review. If you already have your property and your entity set up within Xero, at this point you can sync with Xero. But most of you won't have that done yet. We'll show you how to do that in other videos. So click Continue without using Xero. This property has now been added into our Portfolio Tracker portfolio. At the top, we're able to adjust some variables. This is the loan to value ratio target. What this does is, with 80%, when our loan to value ratio dips below 80%, and as you can see down here in year FY15, it's at 73, it'll tap back up that 7% to the 80% level to say that there's surplus equity to invest, in this case $40,000. As you can see, as our loan to value ratio reduces over time, the surplus equity to invest grows. As you can see, you're able to see years 1, 3, 5 and 10 in terms of future calculations for growth for our portfolio. If we want to click on Show All Years, we're able to see all 10 years. Scrolling down, we're shown an overview, statistics, cash deductions, non-cash deductions, and then a summary. In the summary, we're able to see the total deductions, the net profit and loss, tax refund, any land tax applicable, and then a before and after tax cash flow position for that property. After clicking on results, you're taken to your individual properties page. This page holds all the information that you've just inputted to be able to give you a view and a snapshot on your property. We've got some more in-depth videos that go into this page and some of the data that's held within it. Check out our videos now online on our website.